Tariffs didn't tank the economy, gold just passed the euro, and U.S. manufacturing is booming. Remind us again what the experts got right? CPI barely budged. Jobs data better than reported, gold surging past fiat currencies. Micron and GM are pouring billions into American factories. If you still can't tell deflation from disinflation, we've got you. The narrative's cracking, and the numbers, they don't lie. Watch the full video, because this week exposed just how wrong the mainstream really is.
Hi everyone, I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Ferrian. He's the CEO and founder of Flying V, our digital marketing partner. Rob, how you doing this week?
Gary, I'm doing really well. Happy to be here. Today we've got an issue titled "The Tariffs Didn't Create a Disaster Issue." So we've got definitely updates on tariffs as we work through this week's version of the 5 things. Gary, checking in. I'm still home based, Southern California. I know you've been traveling. Any new updates or developments? Where in the world is Gary before we dive into the 5 things?
A couple. I'm actually still in Lisbon now, loving it here. I just made arrangements with my current landlord to stay for longer. Really fantastic place. Yesterday, I spent all day climbing up and down a mountain in Sintra. It's this tiny little beautiful town about 20 miles from here, where I was climbing up on the ruins of a 1,000-year-old Moorish castle. There are all kinds of other castles and beautiful architecture there, and the photos are incredible. When I was back down in the town and looking up from where I'd climbed down from, I couldn't believe I'd done that on foot. Also made plans to meet my old partner from Silver Arrow, Raji Kabaz, and his wife Diana, their son Cash, in Austria and Poland in a couple of weeks. So I've got a big road trip or plane trip or something coming up in the next couple of weeks. So it'll be Sintra to Lisbon to Vienna to a variety of places in Poland, and then eventually back here to Lisbon.
Very good. Love to hear it. And keep us in the loop on how things are developing. This week's version of the 5 things, though, again, we said the tariffs didn't create a disaster issue. We're talking about the CPI. We've got a jobs report that came out as well. We'll update you on that. Gold makes an appearance. We're talking about some new production capacity, billions of dollars, couple companies announced. And then finally closing out, we got a guest on the show, intern Sam Jane. He'll be discussing the difference between deflation, disinflation, inflation, everything you need to know for our 5th and final educational thing. Gary, first thing, let's get right into it. We're talking about the CPI. It did rise. The tariff Armageddon has yet to arrive, as we mentioned, in the tariffs didn't create a disaster issue. Thing number 1, CPI rises, but less than fiat economists warned, excuse me.
Yeah, so Rob, you remember how for the last couple of months, everybody's been telling us, oh no, tariffs are going to create a horrible inflationary problem. It's going to be a disaster, Armageddon, horrible, horrible. You remember all that?
Yes, I do. I remember all of that.
Okay, so here we go. The May Consumer Price Index report, the CPI, that is the report that people typically refer to when they talk about inflation, that showed an overall increase of 2.4%. That was up 0.1% for the month. The annual number is up 0.1% from April, in line with expectations. The monthly down 0.1%, below expectations. Core CPI, which excludes food and energy, was up 2.8 versus last year and up 0.1% for the month. Guess what, Rob? That is consistent with the prior month of 2.8%. For everyone listening to this, if I just threw too many numbers at you and you're confused, I'm going to make it really, really simple. The inflation report looks almost exactly the same this month as it did last year. There was no Armageddon. There was no horrible outcome here. So I just threw all those numbers at you quickly because it doesn't matter. The numbers are almost exactly what they were a month ago. For a little detail on this, energy has been a tailwind. It looks like that's going to reverse. Shelter, the fancy word for housing, has been a headwind. That also may reverse. So one of those is up and probably is going to be down. The other one has been down, probably going to be up. And here we are, again, more of the same.
Yep, no doubt more of the same, Gary. And then We have been hearing about this tariff-related disaster, right? I mean, where is it, right? Or how far off were people? Seems like the stock market has been resilient. Obviously, we had a lot of stuff happening last week with Israel and Iran, right? But where is this disaster that everyone has been talking about?
Well, so the situation with Israel and Iran has gotten people concerned, particularly about energy prices, and there are worries that Iran does have the capacity to close the Straits of Hormuz. If that happens, you're going to look at much higher oil prices. But over the weekend, or last week, or over the weekend, oil prices did rise. Brent crude was up. So that's when I say that energy prices have been a tailwind on the CPI, and that's likely to reverse. That's what we're referring to. And look, as much as I like to make fun of the Fiat economists and all of the tariff hysteria, the truth is these prices can take time to move through a complicated supply chain. But the fact is, they kept saying it's going to be a disaster, and I'm waiting for somebody to say, okay, yeah, we got it wrong. Now, it could happen in the future, but as of now, there is just no evidence of these massive price increases that many people feared. And so we'll be watching it, but I'm waiting for somebody to say, yeah, we got it wrong, and then go figure out why.
Right, yeah. And then, Gary, in terms of the Fed, I mean, what do you think the Fed's going to do? What can they do? What's their positioning?
Yeah, so Rob, we're recording this on Monday, the 16th. The Fed is going to come out with the end of their monthly meeting in just 2 days. And the current consensus is that the Fed is going to keep rates unchanged. I agree with that consensus. There's just no reason for them to do anything right now. The fact is, with the CPI at 2.4%, the core number at 2.8, they're still above the 2% target, which I continue to believe is 2% too high. So there's really no reason for them to do anything. The other thing is, I don't think there's anything the Fed can do right now. It's going to take spending cuts from Congress, something that's not going to happen. But, if you remember back into September, the Fed over a 3-month period or 2-month period, whatever, September, October, November, they cut 100 basis points. That's 1%. And when they did that, the rate on the 10-year Treasury rose by 100 basis points. The market was pricing in higher future inflation. So if they keep rates the same, then it's more of the same. If they lower rates in a nod to President Trump, which I certainly don't think Jerome Powell is inclined to do, we're going to just end up with higher long-term rates, which is something the Fed can't control. The only hope for this is spending cuts from Congress. And you saw they vomited out the Doge suggestions and basically said, yeah, we're not doing any of that. The big beautiful bill is going to result in more spending, as we told everybody a year ago.
Yep.
A year ago, we told all of our viewers that, there were lots of reasons to go vote in the election, but no matter who you voted for, we were going to see higher government spending and continued inflation, and that's where we are. This is not a team red versus team blue kind of thing. This is not a Trump versus Biden or Harris kind of thing. It is simply that Washington will always spend more. They never cut spending, and that's the case regardless of which party is in power.
Yep, that's so true. And Gary, you have been saying that since day one, and we've seen it, and we've told people that, whether they believe it or not. Some of them just will not for whatever reason. It's hard to have conversations with those types of individuals. Anyways, moving to thing number 2.
Where did that come from?
Well, I mean, it's you're right. It doesn't matter blue or red, right? They're going to spend. And what my point is, you present those things to audiences, right? And depending on what side they might be on, they fail to acknowledge it one way or the other, right? Which sometimes just is obviously very frustrating.
As we've said many times, the Democrats want to spend more, and they should be shamed for being communists. The Republicans tell you they want to spend less, and they should be shamed for lying about it because they spend as much or more than the Democrats do. So I don't know.
I love that.
I don't know. You've got communists on one side, you have liars on the other, and nobody's spending any less. So that's
right.
The issue.
Great stuff there. Okay, moving on to thing number 2, Gary. I'm cracking up as I'm preparing my notes here, but I know what thing number 2 is. My notes say the press misleading us about a particular report. We talked about the jobs report earlier in the opening. You're saying that, hey, it might be better than many think. And then thing number 2 says the press misreads the job report, which I'm sure it is either they misled or they might have just misread it and have no idea what they're talking about. So help us break that down.
So it's kind of funny that you say that, Rob, because over the weekend when I was writing this version of the 5 things, I went back multiple times. And at one point, I actually had misreads strike through misleads the job report, and it just didn't read right. But, right or wrong, you nailed it. So
yeah.
The reason why I have not been reporting on the various jobs reports for months now is just because they've been relentlessly unreliable. But this time, it was the press that was unreliable. We got the May jobs report that also comes from the Bureau of Labor Statistics, the BLS, and NBC, the National Broadcasting Corporation, derisively reported that, I'm quoting, U.S. added 139,000 jobs in May as the labor market steadily cools. Oh boy, that sounds horrible. Rob, a cooling labor market, that's not good for anyone, is it? So they correctly noted that the new jobs exceeded estimates for 120,000, right? They had 139,000, so it was more than the 120,000 estimate, but it's a decline from the prior month's 147,000. Okay, that's true, but as we've talked about before, Mark Twain wrote about the misleading nature of statistics. I agree NBC's using the right numbers, but I'm very skeptical.
Yeah, Gary, and then if NBC is using the right numbers, I mean, where does the skepticism come from? Obviously, we've talked about in the past, just any sort of reporting that seems to be coming out, regardless of where it's coming from. Is it just that continued skepticism with this information?
Yeah, so the prior White House, one of the ways that they constantly had good labor reports is they increased government employment, right? So they would add thousands and thousands of government employees, and that made the employment statistics look artificially positive. And why would they care, right? It's our money. They were debasing our money supply, so it looked good for them. And one of the things that I always like to do is I like to delineate between jobs in the productive private sector and the ones in government, which are a tax on citizens. So last month, government employment was down by an enormous 22,000 jobs. What that means is the headline number was the United States added 139,000 jobs, but the productive private sector added 161,000 jobs. And so, Rob, generally, the market views beating estimates by a few thousand jobs as significant. In this case, the Trump administration is reducing wasteful government jobs, which helps the economy, but hurts their reporting. Last month, the private sector beat that 120,000 estimate by more than 40,000 jobs. That's significant, right? And so when NBC is saying, oh, employment is down, no, employment among government workers is down. Employment among the productive private sector is actually not only up, but it's up at an increasing rate, beating the estimate by 40,000, but also growing from where they were a month before. So, I think what they were doing was misreading and misleading.
Yeah, complete opposite, right? When we were talking about that bifurcated economy, their jobs reports coming out in which it was reflecting tons of job growth, only for it to be reflected in public sector. So obviously, now we got to look at the information the other way. Crazy how the world turns. But moving forward, again, this is the 5 things by Deep Knowledge Investing. The tariffs didn't create a disaster issue. Please subscribe, or give us a thumbs down and tell us why we're no good. That would be amazing. We actually welcome that. Bring it on. Gary loves it more than anything. You can head to our website, deepknowledgeinvesting.com. Use the Ask Gary feature to submit any questions to the show, as well as check out a free subscription that'll get you added to our email list, and a premium subscription gets you access to all gated content. Moving on in the 5 things. Thing number 3, we're talking gold. Fiat takes the L, Gary says. Thing number 3, gold passes the euro as the world's second largest reserve asset. Just wow, continuing an absolute tear for gold. Gary, break it down.
Well, Rob, first of all, I love gold. I started buying it in 2020 when it was around 1,500. It's now in excess of 3,400 per ounce, more than a double for us. That's great. Now, for those of you who are thinking that I might actually be Peter Schiff, that's not true. A, I don't have a snazzy beard. And B, the position I have that is much larger than my gold position is Bitcoin, which he despises. So that's up 6 or 7x since we started buying it at 15,000. Anyway, last week, gold overtook the euro to become the second largest reserve asset held by central banks. It now accounts for roughly 20% of foreign reserves versus the euro's 16%, according to the ECB, that's the European Central Bank's 2024 data. There are a couple of things going on there. Part of it is geopolitical concerns, and part of it is a gigantic rally in gold prices. But central bank demand has reached record levels. Basically, central banks own as much as they did in terms of tonnage for the back to the Bretton Woods era, for those of you who are economic historians. But because the price has gone up so much, it represents a larger percentage of reserves versus where it was a couple of years ago. Gold is certainly more price volatile than fiat, but it also has more value. The key thing there is it is not anybody's liability. The same can be said for Bitcoin, right? So if you own treasuries, which is the way a lot of central banks own dollars, right? Or they might own, yen, that they don't have a bank vault with stacks and stacks of yen notes or dollar notes. They own the debt of those countries. Well, that's a liability, and that creates a problem. The key thing with gold is it's nobody's liability. Again, same thing in Bitcoin. And then a big part of what's going on are emerging market economies like Poland, Turkey, India, and China have been the largest buyers. I saw reports last week that Chinese buying may be as much as 10x what's reported. I have no way to prove that or disprove it, but I find it to be credible. I believe that China is buying huge amounts of gold and probably not reporting all of it. And a big part of it also is geopolitical risk, right? Countries do not want to necessarily hold more dollars or more treasuries. So there's a lot going on right now, but I expect that this trend is going to continue in the next few years. It's not too late to buy gold.
Yeah, and Gary, I mean, with the central banks, I mean, why are they making this choice? Why are they buying more gold instead of, in the past, more foreign currencies? I think for those of us out there, obvious, but break that down as well, positioning themselves with more strength in gold.
I think there are two things going on, Rob. One is with every major central bank and Congress or Parliament printing massive amounts of their own currency, we're seeing constantly debased fiat currencies. And I think, and we're going to talk about this later in this episode. We have DKI Stark intern Samak Jain coming on to talk about inflation, disinflation, deflation. So we're going to be talking about all of that. But the point is that as our fiat currencies, again, a fiat currency is a government-sponsored currency, like the dollar, the pound sterling, the euro, the Japanese yen, those are all fiat currencies. And they're all being debased. And so the value of what you own is worth less a year from now. You cannot save in dollars. You can't save in euros. You certainly can't save in sterling. And so, people are realizing, wait a minute, we're going to have a negative return on these. The purchasing power of these assets is going to decrease over time, whereas gold holds its purchasing power. The other thing going on right now is there are geopolitical issues. A place where I've had conflict with other people in, say, the FinX community, is I've been warning for years that the BRICS drive toward de-dollarization is something I've taken seriously. A lot of other people have said, oh, no, they can't compete with the dollar. De-dollarization isn't a thing. Currencies are still, crude oil is still priced in dollars. For those of you who, maybe aren't doing this stuff all the time, BRICS stands for Brazil, Russia, India, China, and South Africa. It is a coalition of a couple dozen countries that are actively trying to get themselves off of the dollar. They've talked about forming their own currency, commodity-backed currency. That hasn't happened yet. But the point is, more than half the world is saying we really don't want to hold these, formerly impregnable, fiat assets. Typically that years ago, everybody wanted to own the pound and then it was the dollar, and then they would diversify with the euro. But there's a lot of geopolitical risk right now, and one of the mistakes that the Biden administration made was using the dollar as a hammer against Russia, and we stole their dollar denominated assets. Now, people might say, well, they did it for a good reason. They were trying to protect Ukraine. Well, one, it hasn't protected Ukraine, but what it did was sent a message to the rest of the world that the dollar is unreliable unless you remain in the good graces of Washington, a place that changes leadership every 2 to 4 to 6 years. So when Washington's foreign policy prerogatives change, it's very hard for everybody to stay in step with us. And an increasing part of the world is saying they don't even want to do that. So they really just want off of this. Gold is the asset that you can hold where you don't have to worry about geopolitics. You don't have to worry about somebody stealing your reserves and wiping them out or telling you don't own them. There's really nothing anyone can do. If you own physical gold, you own money.
Yeah, great stuff there, Gary, and that full breakdown. Gary, thing number 4, we're moving. We hinted at it earlier. A couple companies have announced billions of dollars of new production capacity. You're saying that you expect Fiat economists to ignore this when they complain about the tariffs. That's a good one. Bring it on. Give us a thumbs down. Gary, thing number 4, those two companies, Micron Technology and GM, buy in on U.S. manufacturing.
All right, which do you want first, Rob? The good one or the funny one?
Whichever you want, whatever one you want most. How about that?
All right, let's go with the good one. So, U.S.-based memory chip maker Micron Technologies announced a planned investment of $200 billion into American manufacturing R&D. They are expanding plans to build fabrication plants in Idaho and New York. This, I think, is amazing, Rob. They are going to be producing high-end DRAM chips. By the way, Micron makes some of the best dynamic random access memory DRAM chips in the world, and their U.S. output is going to be 40% of total DRAM production. I cannot remember the last time the U.S. was a player in high-end chips. I mean, it probably was when, Texas Instruments had a whole bunch of guys with slide rules and crew cuts right out of the Army making these things by hand. This is absolutely incredible. A lot of the expansion is AI driven, and the company's efforts to increase domestic production is going to return market leading chip production to the US. This is phenomenal news for the country. We have needed to onshore our chip production for a while. This is a huge move. 1/5 of $1 trillion and 40% of DRAM production. In a very funny move, General Motors announced a $4 billion investment into U.S. manufacturing. They're upgrading 3 U.S. vehicle plants, some of them to boost output of electric vehicles, EVs, and some ICE, so internal combustion engines, gas vehicles. And they're going to keep a Detroit factory dedicated solely to electric vehicles, but a big part of the plan is to avoid tariffs and take advantage of tax credits for domestically assembled EVs. Okay, that's a positive development. It comes just 1 week after the company complained bitterly about tariff increases potentially affecting steel prices. Okay, guys, great. So if it really, here's my question for you, and I know, Rob, on this show, you normally ask the questions, but if it's so bad, if the steel tariffs are so bad, why are they increasing domestic production?
Yeah, very interesting. Great question, Gary. And all the thumbs down people, please let us know in the comments. We'd love to hear from you. Gary, on that, I mean, how much of this move is geopolitics? Obviously, you have the world dividing into these two camps.
Well, I think that is a huge part of it, Rob. Micron specified, they basically, if you read their press release, said, look, the world's dividing into 2 parts. That I'm sort of reading between the lines, but they basically said we don't want to be caught behind enemy lines. They talked about supply chains, supply lines. The fact is that the world is bifurcating, and sourcing all of our chips from China or Taiwan or Asia, it's not a good idea anymore. These things really need to be produced, if not domestically, at least what they call friendshoring, at least in more friendly hands. I like the idea of the United States becoming a leader in semiconductor manufacturing. Again, there's no reason we can't start to relearn to do this at a high level. So huge round of applause for Micron. Also, I'm going to contradict myself a little bit here. As much as I'm a free market guy, I did see the value of the CHIPS Act, and Micron did get, $6.4 billion from that. Now, that $6.4 billion is not going to build $200 billion of domestic capacity, but the things that the government did to try to incentivize more domestic production, I think was a good idea. And, really same thing with GM saying we want to do these things domestically and not necessarily be sourcing as much from Asia. I think it makes sense. I think it would be disingenuous to think that geopolitics doesn't play a role in this.
I think, Gary, why do the economists, why do they keep getting this wrong? And I know you've talked static dynamic analysis of the situation. Is that something that comes into play here? And, is that kind of the piece that is the issue of them getting it wrong? And that's a big component that matters a lot when looking at this situation.
So that's my take on this. And when you go back and you look at all these other situations where, the government has implemented tariffs, inevitably, people said, oh no, this is terrible. You're going to raise prices. The economy is going to grind to a halt. And generally it doesn't happen. And the reason for that is exactly what we're seeing here. The reason for that is tariffs incentivize domestic production. So yeah, foreign goods will become more expensive. That does happen with tariffs, but it also incentivizes our domestic manufacturers to produce more. And we were talking about this just a week ago, just as General Motors was complaining about an increase in tariffs on steel prices. We had the announcement that Nippon Steel was buying US steel and investing billions of dollars in additional production. So, these are things that happen all the time. There are also other dangers here. There was a really interesting report. People were writing over the weekend about how China is now going back to potentially denying the United States rare earth elements for magnets that are used in basically all kinds of electronics, automotives, all of our defense stuff. But the way they got there was they took US technology, which we gave them or let them steal, depending on where you are, what's going on. And once they did that, they started to sell at below market prices, at below cost. And we had US manufacturers that couldn't compete with that. They went out of business, and now we depend on the Chinese for things that we need to produce automobiles, to produce electronics, to produce our weapons for the defense system. So these are the kinds of things that should be considered. It's really easy to say free markets are great. We should only be free market. And if people want to sell us goods below cost, we should just take it and say thank you. Well, that's fine until you get to the point where they own the production and you have no domestic manufacturing capacity anymore. And then we depend on other countries, fingers crossed, that we can keep sourcing things. And then China gets to make our foreign policy. There are issues with all of that. But the key thing here is the economists just say, okay, you're going to increase prices on foreign goods. They never do the dynamic analysis saying, but now our domestic manufacturers are incentivized to produce more. More supply can lead to lower prices. And that's, I think, exactly where Micron and GM are going here. A round of applause for both of them. We're just glad to see there are going to be more U.S. citizens working in these kinds of jobs, and we'll have that domestic capacity again.
Yeah, great stuff to see those two businesses investing in that U.S. infrastructure, and we'll keep you in tune with other developments similar to that. This week's version of the 5 things, again, the tariffs didn't create a disaster issue. Please follow our page, give us a like, thumbs up, thumbs down. Let us know what you like, what you don't like in the comments. Head to our website, deepknowledgeinvesting.com. Use the Ask Gary feature. You can submit a question into the show that you might have. And we'd also love if you consider a free or a premium subscription, especially for all those people that give us thumbs down. Definitely head to the website and check it out. Now, Gary, as we mentioned, we're going to transition to our 5th and final thing, which is an educational thing coming from DKI intern Sam Jane. I'll turn it over to you. You're going to lead this with Sam, and And maybe if we could remind everybody who Sam is, we're really excited to have him as a guest on the show and closing out our fifth and final educational thing. Gary.
Thanks, Rob. I'm excited to announce DKI star intern Samaksh Jain. If that's hard for you to pronounce, feel free to call him Sam, or just think of it in your head any way you want. Samaksh comes to us from Rutgers University. He's been with us for a month or two now, doing a fantastic job. Bright mind, great attitude, hard worker. Sam, thanks for joining us today. Glad to have you on.
Yeah, thank you so much. I really appreciate joining here right now.
All right, terrific. So let's talk about a key question we got from one of our viewers. Last week, one of our viewers came in and said, wait a minute, what is the difference between inflation, disinflation, deflation? I thought it was a great question. And so because we had terrific viewers here who asked good questions, let's answer it for them. So let's start with the basic one that terrifies everyone. Sam, what's inflation?
Yeah, inflation is just a general increase in the price level of goods and services over time. It's essentially something that would cost $100 today. A year from now, it'll probably cost $102. It's just that increase in price over time that keeps on happening.
All right. So lately, the inflation has been running far greater than 2%, but we'll let you off on that one. Definitely more than $102 for most things, and certainly for groceries, regardless of what the Bureau of Labor Statistics says. But great description. All right. Now, what is disinflation and how is that different from inflation?
Yeah, so disinflation is essentially prices are still rising, but they're not rising as highly as before. So something that would have already reached $105, now it's only reaching $103. So it's slowing the pace of inflation.
All right. So the example we like to give is if you have an inflation rate of 9% and that goes to 3%, you still have inflation. Your prices are still rising, but because you're going from 9 to 3%, that's called disinflation. It's actually a change in the rate of change for all of you calculus geeks out there. I'm sure you remember your high school calculus. All right, now let's talk about my favorite one, deflation.
So deflation is essentially just a decline in the prices over time. So instead of something staying at $100 till next year, that thing would now cost $97, and now you're happy you can buy more of it.
All right, terrific. So lower prices, people are happy about that. All right, so now let's talk about some of the myths out there about inflation and deflation. So why is it that fiat economists, who we like to make fun of on the show, constantly are afraid of deflation? What do they say is going to happen?
Well, fiat economists mostly just argue that people would not buy the same products right now. They would wait for another year to go and buy whatever they were going to buy right now instead. The logic that doesn't make sense to me, why would you wait to buy groceries for a year? You have to keep eating food. You have to keep buying stuff eventually. Because people will keep on purchasing. They might delay purchases for a few months, but eventually they will make that purchase.
Exactly. That's the key thing. They always like to terrify people and say, if people are worried prices are going to decrease, no one would buy anything. The economy will grind to a halt. We'll all be poor, right? And I remember having this conversation with one of your predecessors, Andrew Brown. He was a terrific intern from the University of Tennessee. And we were talking about this. And I said, all right, Andrew, let's go through what I think your big expenses are. You've got tuition, you have rent, you have groceries, you have a car, you have gas to put in the car, you got to get to work, things going on. I said, what percentage of your monthly expenses have I covered? He said, at least 95%. I said, great. How many of those things would you delay by a year if you thought they'd be cheaper a year from now? He's like, none of them. You need to eat. You have to be housed. If you need a winter coat, you have to buy that. So I think you're exactly right. The key thing is they try to tell us that if we thought prices would be lower, no one would buy anything. But most of what we buy for most of the country are things that we need now, right? You can't delay food or rent or having a car if you want to get to work, right?
Yeah, exactly.
All right. Give me an example then of an industry that is very popular in the United States where prices do drop every year and yet we have huge growth in it.
Well, something like consumer electronics, and I remember the iPhone XS Max would cost $1,500 when it first arrived, but now you can get an iPhone for about $900, and that's happening only because prices are decreasing, and yet growth is happening because more people want to buy that iPhone.
All right. So in your lifetime, how many phones or computers or laptops or consumer electronic items have you bought, do you think?
Well, easily over 15 or 20.
Okay. And when you bought them, did you ever think that the price would be higher in a year, or did you know that they would always be lower in a year?
Well, it's almost given that the prices would be lower because the technology is improving, and especially like older models, they have to sell them out eventually, so they would lower prices for that, which was one of the reasons sometimes we would take an older model, but I would never expect the price to rise later for like an iPhone.
Exactly. Exactly. In other words, the certainty that prices will fall doesn't stop people from buying. It doesn't bring the economy to a halt. Now, let's talk about a key thing here. I want you to tell me what you think will lead to you having more money in the future, right? Let's talk about the economic growth for the Sam Jane portfolio. Is it saving and investing on one hand, or is it spending on, fun things, consumption?
Investing would give a higher return.
Okay, so the point here is that you grow your economy, you grow your wealth, you grow your economic prosperity with saving and investing. You destroy it with consumption, right?
Yes.
Okay, so here's the great question then. Wouldn't that also be true for a society? And if that's the case, right, now I want you to imagine the opposite of deflation. I want you to imagine huge inflation. Let's say prices are going to be up 30, 40, 50% next year. Would you save those dollars, or would you buy as much as you could right now?
Honestly, I would buy right now because I know when prices are that high, I will not be able to afford whatever I'm buying at this price today. So it would be logical to buy today.
Exactly. So the point is, stable prices encourage smart people to save and invest, and that's what grows the economy. Rising prices encourage people to consume, making us all more poor. All right. Well, Sam, you are now miles ahead of every PhD level economist working at the Federal Reserve. This is why, if I had my way, I would take you and Cashin, our other star intern, versus everybody at the Federal Reserve, and I think we could run a better economy with just the two of you in that building. What do you think?
Well, I don't want to be overconfident, but I think that's plausible.
All right. 5 things, DKI viewers, I present to you the next chairman of the Federal Reserve, Sam Jane. At a minimum, knowing the difference between economic growth caused by deflation or stable prices and the economic growth lost with inflation puts him miles ahead of at least Jerome Powell and Janet Yellen. Right.
Very good, Sam. Thanks so much for jumping on. Appreciate you shedding some insight. As always, we'll bring additional educational topics to this week's 5 things. To close out, Gary, I'll turn it over to you for final closing thoughts for this week. And thanks everybody for watching. We'll see you same time, same place next week. Gary, turning it over to you for final thoughts.
All right, big round of applause for DKI interns Cashin Crow and Samaksh Jain. These guys are finally back in the United States, fully operational Death Star here. Great job by both of them this week doing terrific research. The writing is really good. The images are good. Good job, guys. Great to see. Rob, as always, thanks for doing this with me and for putting so many of Flying V's great resources behind everything we're doing at Deep Knowledge Investing and with the 5 things. And for everyone watching this, thank you so much. We know your time is valuable. We appreciate you spending it with us. If you want to give us a like or subscribe, that would be terrific. But hey, do what you want. We're not the boss of you. Looking forward to seeing you next week.
Thanks, everybody.